So we had a couple of bloopers. Kiddies, corporate earnings. This is going to be our Yield Boss educational video for this week. We have more than a few educational videos that we put out in the past couple of weeks. Make sure to go view those. There is a ton of alpha in these videos. But for this one specifically, we're going to talk about what drives the S&P 500, which is corporate earnings, okay? Remember, corporate earnings are the net income, which is basically post all your gross and bills, a company generates during a specific period of time. Now, we'll go through the time periods, how they're detailed, but this is the number one most important reason why the S&P is being driven up the past 4 years. You consistently hear on mainstream media channels that GDP is high, and this is based off both quarterly, monthly, annual, and PE ratio dictated through earnings. Remember also that corporate earnings dictate how the labor force is health-wise as a whole and where inflation metrics are. Remember, if a company can take out a loan from a bank, let's say it's Nike and they want to expand, they take out a loan from JP Morgan, then their labor force is going to grow, their forward EPS is going to grow, guidance may look good, and analysts may have higher expectations for that. As corporations grow and earnings grow, there is a healthy amount of inflation that comes with that. In any economy, you want to see that healthy growth of inflation. The problem is when you get to periods like now where they're issuing too much debt, printing too much excess money via QE. But in total, corporate earnings is your driver of the S&P 500. Now let's get into each part and review. Any questions you guys got, remember, hit us in the comment section.
Corporate earnings are broken down into the following focus periods. So we have monthly, quarterly, 6-month, annual, and then you have your P&E, which is derived from your trailing previous 12 months. The quarters are broken down as follows. So you typically have your Q4 earnings coming in January of 2025. You have your Q1 earnings in April, Q2, July, Q3, October.
And one thing about that that's important to remember is that a lot of times on mainstream media, whether it's CNBC, Fox, whatever, when you get into Q1 of the next year, so let's say January through March of 2025, they will say on television that they're reviewing Q1 earnings when it's not really Q1 earnings. It's Q4 of the previous 3 months. So in January of 2025, they reviewed earnings for October, November, and December. Okay, now getting into how they're rated and how analysts set their expectations each month, each quarter, etc. First is EPS. EPS measures profitability per share. This is your net income divided by your shares outstanding. This is important because market cap matters when you're talking about EPS, when you're going over the Mag 7 stocks, mid caps, or small caps. A larger move on, let's say, a small cap stock of earnings per share can move it more because it has less shares outstanding. So if you see something like Tesla or Apple come in and they meet their EPS or they beat by just a little bit, you might not see their stock make some, exaggerated move, but on a small cap, it may make a move of 10+%. It also depends on where you are in your sequence, et cetera, et cetera. But when you're looking at EPS, you're also looking at earnings surprise. So analysts on the street, they come in with expectations. You look at each bank, they'll have some majority, like middle level consensus, usually with some outliers. But if there's an actual surprise on that company beating in some way, shape, or form on their earnings per share because of different things that they did from a operational standpoint or a revenue standpoint, then the stock can make a more exaggerated move to the upside or downside if they have a bad miss.
So you have two different ways that you measure revenue for corporate earnings. You have year over year and you have quarter over quarter, and those are rhetorical. So your year over year revenue just simply compares your earnings to the same quarter previous year, and your quarter over quarter measures that sequential improvement per quarter.
Okay, so next up is price to earnings ratio. Okay, this is the stock price divided by the earnings per share. The reason this is so important is because it forecasts future growth within a company quarter on quarter, year on year. Now, looking at this graphic here, we're looking at the S&P going back to 2019. You can see the earnings ratio, just market wide. It was around the 20s until we got to that June 2020 level when QE started to kick in and the PE ratio maxed out at 39. Now, this is highly unusual, and the only reason that happened was because the egregious amount of money printing and debt issuance because of COVID. Since then, though, one of the main narratives of the market and why it's continuing to plow higher is that earnings growth has been consistent every single quarter, but more specifically to the Mag 7 and the magnificent 10 to 15 stocks that have been carrying the S&P higher for the last 4 years and change. 25-ish, in that 23, 25 range is where we have been. And this is what mainstream media keeps pumping into your televisions every single time you look at what companies are doing with corporate earnings. If you are an asset manager, okay, a portfolio manager, you work for an investment management wing in an insurance company, you are looking to buy quality stocks that have a quality price to earnings ratio to further your gains. Now remember, price to earnings ratio is how much investors are willing to pay. It's a multiplier for each dollar of a company's net earnings. This is not to be confused with gross revenue. I'm going to break this down for you now. For a company's earnings, let's use Tesla as an example. And I'm going to give you a hypothetical. Let's say Tesla made 50 million in net income, not gross revenue, in a quarter. First, you annualize it. Okay, so you do 50 million times 4. You come up with $200 million in net income. Okay, you take that annualized net income and then you divide by the number of outstanding shares that Tesla currently has. Let's use another hypothetical. Let's say it's 2 billion. 200 million divided by 2 billion is 10 cents per share. Now that you have that exact 10 cents per share number, you divide it off of the current price of the stock. So let's say Tesla's trading at $2. $2 divided by 10 cents is 20. 20 is your forward PE for the stock. So any single time an asset manager is looking to invest in a stock and diversify his portfolio, they're looking for a PE ratio of something around that maybe 20 range. Okay, it shows that there is solid future growth in that stock. If they want to look at discounts, they can look at a PE ratio of something like 15 if they know this potential narrative that's going to be built in, and maybe a company is going to be doing something big in the next couple of years. But that is really your sweet spot. You don't want to be investing in stocks that have 28 to 30 PE ratios, and definitely not stocks that have 100 PE ratios or 200, because those are incredibly overbought. If anything, you look at those stocks and you say these might be good positions to take hedges on moving forward and to protect your portfolio.
All right, next up we have EBITDA. This is your earnings before interest, taxes, depreciation, amortization. This is your net income margin. It measures the efficiency of profit. This is the number one thing that took WeWorks down.
WeWorks and their CEO, Adam Neumann, was not able to put together a conclusive EBITDA report when WeWorks IPO'd on the New York Stock Exchange. It showed consistent cracks in their revenue growth as opposed to how much debt they were accumulating during the period of time leading up into the IPO. So this is one of the most important reports. It is very, very dry. It is very numbers based, but it shows the absolute net numbers and how much a company is actually growing once you take away all the other fluff numbers that can dilute the earnings per share.
So the other main way that earnings reports are rated is your actual performance versus your forward guidance, or likewise your forward guidance versus your actual performance. So the company provides a forecast during their earnings report, and then you get the real result at the earnings of the next quarter, right? So this is your beat, meet, your miss, and then you have your TTM, your trailing 12-month earnings, and this is just used in price multiples, very similar to the P/E ratio.
In conclusion, I want you guys to make sure that when you're leading into any type of corporate earnings, that you're also viewing the chart. Like Darren just said, stocks can meet, beat, or miss. And a lot of times the earnings estimates from analysts on the street don't give a clear view of where a stock is going to go leading into that high IV period. After earnings, you always get a significant IV crush. It is really essentially important for you guys to take note. If a stock's running into earnings, it's probably not good. But if it's falling into earnings, there's a chance that it can have a very serious bounce. When there's high expectations of a stock, especially for earnings, a lot of times it's already priced in. If missed guidance comes or there's a weak forward outlook, things are probably going to make a turn further on the downside. Always use the right tools and resources as well when you're looking at earnings. Darren and I like to use Yahoo a lot. TradingView can be kind of shaky. A lot of the analyst expectations you guys see on like Seeking Alpha or the NASDAQ, Benzinga, things like that, they can give you a solid, clear view of what's going on, but they're always going to be different. They're always pulling their data sources from different places, so you can't really trust one over another. Make sure Yahoo or Bloomberg is kind of where you're staying at when it comes to resources. Keep that in mind going into our next earnings, which is going to be October. This will be Q3 earnings. This is taking into account the previous 3 months of July, August, and September. Right now, we are still in Q2 earnings. There still are a lot of earnings firing off. So a lot of homework that needs to be done. Stay frosty on the charts. Identify which stocks are in a extremely overbought or oversold period that may have a large phase D or phase E in Wyckoff move on their earnings numbers. And make sure to protect yourself from that IV crush just in case things don't go well. Your options will get hit. Always make sure to have hedges in place.
All right, and that concludes the video, guys. We're going to be doing plenty more of these educational videos in the to come. Go ahead, like, retweet, subscribe. This is going to be on multiple platforms. So talk to you soon.